You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Richard Knowles of Knowles & Associates in Vancouver. He's a financial consultant and a wealth manager. Welcome to the show, Richard.
Thank you for having me, Jim.
Once again, the International Monetary Fund is making noises about Canada's so-called real estate bubble. They say they want to see higher mortgage rates. Do we need higher mortgage rates? Don't rising prices kind of control what people buy?
Well, with the mortgage rates, what's a really big concern is interest rates, of course, and what that's going to be happening. We really don't know. There's been a forecast in the news recently stating that the government and the banks believe that there will be a starting to increase interest rates sometime, perhaps, and this is again very speculative, perhaps next May. Now, the assumption in all of this, of course, is that the markets and the economy continue to be stable as they appear today. Now, the irony to that, or as they've appeared, say, over the year, the irony to that is that we aren't really that stable. The markets, while they're at all-time highs, actually, we're looking pretty good if you're looking at the index, et cetera. And there are individual stocks that are, of course, don't care. They just keep going. If you look at the stock markets as a reflection, of what's going on in the economy, you'd think the economy is doing well because we're at all-time highs, seems to be gangbusters going forward. But the actual fundamentals of our economy, job growth, actual unemployment figures as opposed to the ones that we see posted, other recessionary issues have not been alleviated. So our economy is not showing us the numbers to substantiate our current belief system that's reflected by the stock markets. So one has to meet the other. And what is generally the street is kind of calling for a correction. We don't know when, because we're going into a very good time, usually for the economy. This is the time between November through to about March. Typically, that's a very good time to be in the stocks and the stock market in general, and the economy is usually its best during this period of time. There are variations on that theme, but the general belief system right now, we don't have a global world war, for example, looming over us. We have a nice, stable sort of environment, at least North American-wise and European-wise in most countries, moving through this time, through the Christmas season, through the holiday season, where spending goes up. Lots of good numbers will be posted by economists of growth and companies and dividends, et cetera, will be going up. We'll see the stock markets increase. But it's believed that sometime in the early part of the spring, there could be a correction. Now, if we see a correction coming off, that will probably put us better in line with what the true economic numbers are. I believe that will happen. I'm in that camp. And if that does happen, then interest rates will probably not increase. We won't be increasing interest rates if the markets and the economy are showing a bit of doom and gloom. They'll keep interest rates where they're at. If they do have an increase, and they still increase it if that were to occur, it would be very, very nominal, very small. It would just be a token increase. And in fact, no one on the street or in the industry, in the financial world, really believes interest rates are going to suddenly escalate, ridiculously over any period of time. It may start in May, but it could take 3 to 5 years to have any major increases put back to interest rates. They really want to take this very slowly, very carefully. And this is a global phenomenon. But one of the big key features to this increasing interest rate is to protect the Canadian dollar dropping. That's a way to support the Canadian dollar because you want to get global investment coming into the country. One of the best ways to do that is to provide a higher interest rate on your government bonds, which we sell to the world. So if we can bump that up a bit, it makes it more attractive for international dollars to come to our country, and therefore could support the demand for our actual dollar and hold its support levels where we're at now. So that's a bit of a ploy there. But, it's a balanced act. We can't increase it if the economy can't handle it.
You keep seeing in the financial papers, people are decrying falling oil prices, and OPEC is discussing right now whether they should tighten up supplies to bring up the price of oil, because they say if they don't, it'll drop to $60 a barrel. However, what about consumers? A study I saw said for every 1 cent drop a gallon in the price of gasoline in the U.S., that puts an extra $1 billion in the pockets of consumers. And so using the same formula here in Canada, a 4 cent a liter drop in the price of gasoline would put $100 million back in the pockets of Canadian consumers. So where's the balance here? What's better? High oil prices so the government gets revenue from it? Or how about lower prices for consumers? And it affects everything you get because, as they say, everything you have in your house got there by a truck.
Yeah, that's very true, Jim. It's a very good point and a very good observation. The reality right now that we have is that it's a very fine line we're walking here. One of the problems of being a Canadian today, in general, is that our economy has been structured, literally structured by default, not necessarily by design, but yes, by design initially, but now by default. We're structured around our resource base. We have built a country which requires us to sell resources to the world. And this is a problem now. And here's what the problem is. When you see our stock markets, for example, most of the companies in Canada, not all of them, of course, but most of them, reflect a large sector of the energy and mining companies, certainly in Canada and even in the world, because we represent so much of the mining and oil and gas. Even if we're in Canada, we have international concerns in these areas. We have become a specialist. And this is a problem. You specialize in one sector or one section of any economy in any way. You can have great years when that specialized area takes off, and you can have terrible years when it doesn't. So our problem is lack of diversification. And this has become an insidious kind of problem in our country. And here's what I mean by that. When we have oil, particularly oil, which is the center post now of our economy, it has been built to be. You look at Calgary, Alberta, it's the center post of their economy, period, for sure. And even now they're talking, they just announced that Alberta will be slashing their oil price forecast, as well as they're vowing to cut spending in their fiscal update, because they're totally expecting to have to take money off the table. And in so doing, that's what we call a micro reflection of how the federal government feels right now. They're worried, and this is why so many things have been run. So what we call just paved over any kind of process to stop oil tankers from coming to the West Coast. All of the environmentalists have been run right over by the current federal government. They've stifled scientific studies that will show that certain places you shouldn't have pipelines. These were things that 20, 10, 15 years ago we would normally do. We would consult the Aboriginal nation. We would, these were part of our laws, and now suddenly under this current regime, the Harper conservatives, they have taken it on that they have stifled all of these things. They've reduced the control of scientific studies. They've completely stifled all of the scientists of the federal government. In fact, they're under threat of losing their jobs if they even speak out against their own employer, the federal government at this time, if there's some study that shows a defiant stance. And all of these issues are being pushed under the rug so that we can push oil out. And because of this dependency and focus on oil, we have a split problem. One, because we're pushing oil, we're dependent on oil pricing. So if oil pricing by OPEC and others are going to drop our oil price, our whole economy now suffers far more than when we had a more diverse economy. And the second part to this is that other ventures, venture capital and developments in areas of solar power and alternative energy, we can obviously see the federal government, who is now a supporter of big oil, the current federal government certainly, has no interest in helping other alternative fuels come in and push oil out of the way. So therefore there is a conflict of interest against any kind of development of alternative energies, which, we see in Germany today. They've been effective in putting in solar power to reduce their dependency on oil magnificently as a global leader. It's quite phenomenal. And you think Germany is hardly a sunny climate, and yet the efficiency of solar energy today is so profound, so well established, and very, very well done. So we have these two conflicts of of dynamics going on within, then that's at the federal level. But then you get the consumer. And this is where they're sort of smiling, and yet, you wonder if you want to smile or cry. If your economy is dependent on oil, will we as an economy lose jobs? I mean, where is your job today? Where is it dependent on? If you're dependent on an oil-based type of business, which requires oil to be high, you're going to be very sad. So people in northern Alberta, anywhere in Alberta probably are not feeling happy about this. Whereas everybody else that is not necessarily dependent on oil at this time, or we'll see, for example, prices drop in their food. I mean, that's fantastic news. They'll see prices drop in their gas, which is the major transportation issue today. This wonderful news from a consumer standpoint. It's some of the best news we've heard in a long time. However, what will that do to our dollar and our markets? The markets will drop, so our investments have to be much better chosen. You can't just be buying the Toronto Stock Exchange Index ETF, because that's so heavily exposed to energy and oil that you will see negatives in that. Whereas if you could be more selective in your choosing, say buying financial services, getting away from energy sector, you might see an upward momentum in your investments. So really, it's smart investing today is the big point. And, where I think the happy people are going to be those that are not related to the oil and gas sector. That's about it. But otherwise, there's a major consumer boom for them. Much more spending, a lot of more money on the table.
We'll have more with Richard Knowles right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to financial consultant and wealth manager Richard Knowles. Richard, people always say you should invest like Warren Buffett, but you said there's kind of a new Warren Buffett rule maybe other people don't know about. You find it interesting. Maybe explain it to us.
Well, the Warren Buffett-esque approach is he actually has a set of criteria that have been studied very well. Some things he's announced, some things have just been sort of visually studied from his acquisitions. And, we were talking about this off air, but one of the key features is that many people know Warren Buffett is one of the wealthiest men and one of the best investors on the globe, on the planet. He's well in his 80s, and he's done extremely well with his common sense approach. Some of the more commonly known ones by names ones that are around you every day, and you walk through your kitchen, you walk through your home, you walk through other people's kitchens and homes, and you see these names that are in every home, every major place you go. So that's one way of buying, a stock. How many cars are on the road? I mean, who's drinking Coca-Cola? I mean, these are some of his big holdings, Coca-Cola being one of them. And, whether you agree or disagree with sugar and everything else, being in people's diets, the reality is that people like Coke, and they buy it, and it's everywhere you walk around in the United States, certainly, not so much, say, in Canada, but in the U.S. it seems to be a staple. And if, Disney is another thing, that just keeps making more money all the time, great dividends, etc. So these are some of the ways he looks at the basic idea, and that's known by a lot of consumers. But one of the better ones that was recently brought to my attention was the way he buys based on cash flow and debt. So these are more fundamental issues, things that you really want to look at the underlying characteristics of any company or stock. And, for example, IBM is one of his big holdings. And if you looked at IBM's returns recently, they haven't been exactly, great. You might think, oh, this is not a great company to own, but you really have to know a company. If you're just looking at the stock price, you don't know the whole story. So you have to look at the news, you have to see what their cash flow, you have to see their position, to look at their books. And so he looks at the books, and he sees one of his criteria is he never buys a stock that the debt of the company can't be paid off with 3 years of earnings. So a good example of that in this case, it was in the news, IBM. IBM happens, now don't quote me on this, but I think it's approximately $16 million a year. I don't have the numbers in front of me. $16 million a year is its earnings, and it has a debt picture of about 30 or 35 million. So they can pay off their debt pretty quickly in about 2 to 3 years. Another one would be Apple, which was being cited at this time. It's in the same kind of cash position. It can pay it off even faster, actually. Actually, I think I just gave you the Apple number, 16 million and 30. The IBM it's a little bit higher. It's something, their earnings, I think the payoff it takes about 3 years to pay off IBM's debt. So that's a really good position. So having to look at practical ways of buying things, I think this is a common kind of way of looking at things. I think common sense should prevail, whether you're looking at your home purchase, whether you're looking at a stock purchase, whether you're looking at anything really to buy. You want to look at its value to you, and what is the amount of debt that's there, and what's the earnings of that investment to be able to finance that debt. Is it doing well? Like if you buy a real estate property today as an investment rather than living in it, and you want rental income, is the rental income strong enough? What's the rate of return of your rental income to the price you're paying for the house? If you look at the price you're going to pay and that the income you're going to make is at about 3 to 4% of the price you're paying. That's like buying a stock, which would be paying you a dividend at 3 to 4%, for example. But you're making it as income from the rent. You don't want to be overpricing it. In other words, if you look at renting out a property and you want to do that, I think Canadians should do a lot more of that if they feel confident and they know what they're doing. It's a way to build assets in a good property area. You can be buying at good prices and have solid rental income as long as the people there have jobs, and you've got students are great for that if you can find good solid students in senior years at universities. And these kinds of ideas are where we have to think outside of the box to be successful today. It's not just going to work and making an income, although that can work too. And we used to count on our pension plans as well. And now, where are we going with that? There's no more pensions. It's harder to find companies that are willing to support us and give us this free money. They seem to be making money hand over fist, but pension plans and other things where we have these levels of security seem to be disappearing off the face of the map. So, where are we going? Well, use common sense. I love the Buffett-esque approach because it looks at the numbers, it looks at debt, it looks at pragmatic things which allow you to make decisions which are sensible and long-term safer than higher risk growth stocks and things that you can't measure and you don't know where they're going to be in the next 2 years or 3 years from now.
Richard, thanks a lot for chatting with us.
My pleasure. Thank you for having me. My
guest has been Richard Knowles of Knowles & Associates. If you have any questions for Richard, you can send them to Richard K, that's the letter K, at CustomPlanFinancial.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. We're also available on YouTube channel Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.